Hello friends, very good evening greetings to all of you. I really hope that the New Year celebrations are on because it's 31st December evening and at the same time you might be taking care to pack yourselves very well in order to maintain the inner warmth of the body. That is, in order to maintain yourselves cozy, you are well packed up with the warm clothes. So, the warmth of the festival as well as the warmth of the body both need to be taken care of. So, I, Kunal Nagpal, welcome you back to this great economic session. That is the last economic session of this current year. So, dear guys, let's begin with today's session, today's evening session. Basically, we would be very delighted to know that the bank credit jumps 18% in November as retail corporate loans pick up. This is a very good news. The bank loans surged nearly 18% in November compared with 7% a year ago, that is November 2021, reflecting demand buoyancy from both individuals and companies despite an increase in financing costs since early summer. The credits to the industry continued to register a strong pickup, with the total loans accelerating to 13.1%, while the personal loans expanded at 19.7% in November, largely driven by housing and vehicle loans. Within the industrial credit, loans to large industries rose by 10.5% as against a contraction of 0.6% a year ago. Medium industries recorded the credit growth of 29.7% in November compared with 37.4% last year. The credit to the micro and small industries rose by 19.6% versus 15.3% a year ago. During November 2021, the total credit to industries had grown by a paltry 3.4%. We are actually seeing the credit growth at several year-end levels, which is actually very high, of 18%, and it is broad-based across several sectors, that is retail, industry, services, etc., said Mr. Suresh Ganapathy, Associate Director, Macquarie Capital. The current loan growth also is a function of base effect. For nearly 2 years during COVID, the loan growth was 6% on an average, whereas the deposit growth was at 11%. So, next year, the base effect should actually normalize, and already the economists expect GDP expansion to slow, and hence we can see the credit growth coming down to 14 to 15% and the deposit growth inching up to 11%. Over the last couple of years, or from March 2020, the credit offtake has mostly overcome the COVID-induced lag, which has grown by around 25.2% to almost catch up with the deposit growth of 27.3% over the same period. A study by Care Ratings showed. The central bank data also showed that the credit to agriculture and allied activities rose 13.8% in November 2022 as compared with 10.9%. Credit to the services sector also registered a growth of 21.3% versus 3.2% a year ago, that's in 2021, primarily due to the improved credit offtake to the non-banking financing companies, that is NBFCs, commercial real estate and trade sectors. Credit growth has been on an uptrend with the wholesale and retail contributing, said Mr. Sanjay Agarwal, Senior Director, Care Ratings. The credit outstanding of the industry segment has grown due to the inflation-induced higher working capital demand. Corporate borrowings indicate decreased bank funding as the bond yields have prompted the companies to optimize their borrowing cost. Despite a significant increase in lending rates of the banks, the headline rates continue to be attractive compared to the yields charged in the capital markets. The interest rates have climbed 225 basis points since early May. And I would like to remind you, 1 basis point is actually equal to 0.01%. So it is so well articulated, and at the same time, it's very insightful with an in-depth analysis. Next, we are going to analyze and go through the 10 numbers that actually defined Indian economy in 2022. Given its sheer size and diversity, India will always throw up fascinating numbers in any given year, some as the reasons to celebrate, some as the wake-up calls. Here is a selective list of 10 numbers that defined India over this last year. First number is 6. For virtually the entire year, consumer price inflation remained above 6%. The danger mark established by the Reserve Bank of India. It inevitably led to a 1.85% rise in repo and interest rates, saddling the consumers with higher EMIs. Very high food inflation, often crossing double digits, was particularly harsh on the lower middle class and aspirational Indians. 2023 promises a gentler inflation rate. That's the good news. Now the second numbers are 258 and 156. BJP lost Himachal Pradesh to Congress but notched up the record-breaking victories in Uttar Pradesh and Gujarat. Mr. Adityanath became the first sitting UP Chief Minister in independent India to be voted back to power with 258 seats in March. In Gujarat, the Modi magic was in full display in the month of December, as the BJP won 156 of the 182 seats, breaking the record set by Congress in 1985 with 149 seats. Now the third number is 62,000. The Cassandras have been bleating about the doomsday approaching for India's stock markets for a while. Their grim forecasts started coming true after Russia invaded Ukraine in February and the Sensex tanked below 55,000 in May. When the foreign institutional investors started running back to the safer havens in the United States, disaster loomed. Yet the resilient India story won out again and Sensex broke the records to cross 62,000. Perspective, in the first flush of the post-liberalized India in 1992, it had actually crossed 2,000. Now next figure is 100 billion. The remittances to India will touch $100 billion for the first time. For decades, the inward remittances by the overseas Indians have been a lifeline. They remain so. The difference now is that the remittances from the skilled white-collar Indians is actually exceeding those from the unskilled blue-collar workers, mainly from West Asia. Next figure is 20 million. The political war of words over the status of J&K, that is Jammu and Kashmir, continued in 2022. But the tourists gave an overwhelming thumbs up and broke all records as 20 million of them visited J&K, the highest in 75 years. For local citizens, the economic benefits of such high levels of tourism are actually immense. In a way, 20 million tourists voted for peace in the troubled state-run union territory. Next number is 60 billion. Give or take a few billion. $60 billion is the amount by which the personal net worth of Gautam Adani increased in 2022, making him the second and sometimes the third richest tycoon in the world this year. The entrepreneur's fortunes keep skyrocketing even as his legion of critics slam his energy-cum-infrastructure empire and forecast a meltdown. In 2022, Mr. Adani became India's biggest philanthropist by pledging more than $8 billion in charity. Next figure is 108 million. For those who think India is actually well on the path to becoming a land of milk and honey, 180 million tons of free food grains given to 800 million Indians at the bottom of the pyramid is a reality check. The Indian state had been giving 5 kgs of rice, that is free rice or wheat, to the poor families for some time. In the wake of the pandemic, another 5 kgs was added under a new scheme that has been extended till December 2022. 2.6 lakh crore rupees have already been spent on this new scheme and probably saved many poor Indians from hunger. Now the last figure is 1/10. This number is actually for the barely hidden jingoist in the most Indians when it comes to Pakistan. By the end of 2022, Pakistan's GDP will be 1/10 of India's. This is assuming India's GDP growth rate is a more modest 6.8% in India. Given that of Pakistan's, this yawning gap between the two 75-year-old countries will keep growing in the years ahead. P.S. China's GDP is actually 6 times that of India. Now, my dear friends, we really need to consider the ride of 2022, and thank God 2022 ride is over. Now, tighten the seat belts for another roller coaster ride, that is 2023. Mood was still upbeat despite Omicron, the third wave of COVID, and the global warning on liquidity tightening as we walked into the year of 2022. There was an overhang of the unprecedented market growth driven by significant liquidity and positivity of 2021, and the Sensex gained almost 4% in the first 11 trading sessions. But soon in the new year, we began to realize that 2022 is actually far from 2021. As was expected, the devil's side of high liquidity, that is inflation, started showing its true color globally. As a result, the domestic and global markets witnessed uncertainty and volatility. Adding to this turmoil, the Russia-Ukraine conflict in February 2022 caused supply chain pressure across the globe. India also faced the ripple effects as the conflict broke out, and the Sensex crashed by around 3% and 4.7% on February 14 and 24 respectively. Now, to rein in inflation, the central banks across the globe resorted to liquidity tightening and started announcing interest rate hikes. In March 2022, the Fed, that is the US Fed, increased the benchmark interest rate by 0.3% for the first time since December 2018. So following the trend, the RBI also increased the repo rate from around 4% to 4.4% in May 2022 after a series of reductions since April 2019. The Sensex slipped by around 2.3% on the day of announcement. These events, coupled with consumer inflation touching an 8-year high of 7.8%, dragged the Sensex down by 10.4% in the first half of 2022 itself. However, the second half of the year 2022 started on a positive note with the Sensex jumping up 8.8% in July, making it the best month of 2022, followed by August closing with a positive gain. The foreign institutional investment flows also turned positive in July after 6 consecutive months of outflows. Just when the market seemed to recover, India's consumer inflation became a worry and the Sensex closed 2.3% lower for the month of September. However, with easing of inflation in October, coupled with better than estimated quarterly results of most companies, especially in the banking and consumer sectors, the market sentiment improved. The positive momentum continued for a while, marking the Sensex at its lifetime high in December 2022. That's really great. The performance of 2022 has been as per the trend observed for the past 10 years. Whenever the Sensex has provided a returns of over 25% in a calendar year, the following year has been a muted return. For instance, a gain of around 25.2% in 2012 was followed by a muted return of 8.1% in 2013. Similarly, with 30.1% returns in 2014, the following year saw a negative return of 5.1%. The same trend was seen when, after a return of 28.1% in 2017, the next year saw a muted return of 6.7%. Again, with a remarkable return of 25.2% in 2021, history repeated itself with a muted return of around 2.2% in 2022. So a lot of new age companies had shelved their market debut in 2022 because of the volatility and the changing perception of the tech companies. In India, the ecosystem of new age tech companies is still evolving. One is not sure that their public debut will pass the test of market expectation. Overall, we had 38 IPOs in 2022 compared with 65 in 2021. Even though the listings are down by more than 40%, India continues to be a bright spot in what was an underwhelming year for the IPOs globally. The silver lining was that the government of India finally listed the Life Insurance Corporation of India, that is LIC, which was nothing short of a miracle. Furthermore, Indian capital market also saw a few historic landmarks this year as it entered the world's top 5 club in terms of market capitalization and as it appointed the first woman chairperson of SEBI. Under her leadership, SEBI has announced significant measures to boost the capital markets, including allowing confidential pre-filing to offer the documents. The regulator is also planning to cut down the time taken to clear IPO documents from up to 70 days currently to 7 days. Also, despite the challenges, the markets saw the overall consummation of some quite interesting and significant transactions like the privatization of Air India, large M&A situations such as HDFC and HDFC Bank Manager, with the overall merger of the bank and the launch of CBDC by the Reserve Bank of India on the currency side. Now, dear friends, looking forward to a next ride, that is 2023. India is actually not insulated from the global macroeconomic headwinds and is likely to see a spillover in 2023. Though, to a lesser extent, while tightening liquidity, increasing interest rates, and re-emergence of China could pose a significant challenge, the increasing domestic consumption and the positive demographic dividend, coupled with great learnings from the 2022 year, will boost the confidence of Indian businesses. The resilient economic outlook and better risk sentiments, I repeat, the resilient economic outlook and better risk sentiments as compared to other markets will continue to make India one of the most attractive emerging markets for investment. The 2022 ride was a roller coaster with its own tight turns and steep slopes. Let us tighten our seatbelt and head with hope into a new year which could again be full of surprises. And you would be delighted to know the author of this wonderful write-up is the founder and the chief executive officer of Nova One Capital. Thank you, sir, for such a delightful reading. It's really worth a pleasure to go through the insights provided by you in such a beautiful manner. Now, coming back to the economic news of the day, the FMCG players rule out the supply chain disruptions. The consumer goods companies said they don't see the disruptions of operations or supply chain issues in case of a surge in the COVID-19 infections in the country. The executives of the companies selling the essential and non-essential goods said they are prepared if the shoppers decide to stock up on supplies amid worries that the country could see another big wave of coronavirus infections. All the stakeholders, including the industry, have learned a lot from the past COVID waves. The disruptions had come down in every successive wave very successfully. Neither do we expect any knee-jerk reaction from any stakeholder, be it the government or supplier, said Mr. Mayank Shah, senior category head at the Parle Products, a leading biscuit and packaged food maker. Even in the worst case scenario, the consumers will surely get their daily essentials as we saw during the Omicron wave. Mr. Anshu Maulik, chief executive of the edible oil and staples company Adani Wilmar, said any fresh COVID-19 wave will not have any challenges, and while the retailers are stocking more, that is mostly to cater to the festive occasions and marriages over the next 3 months, there has been no shortage or supply chain constraints for any food grain or edible oil from an external environment point of view, said Mr. Maulik. The company said there are no signs of the pantry loading yet, but the rumors are on about the possible lockdowns in India if the country sees a China-like surge in the COVID-19 infections in the coming months. At present, the positivity rate and active COVID cases in India are actually below 1%. Also, more people have been queuing up for their third COVID-19 vaccine shot over the last few days, they said. However, these companies are closely tracking the retail level sales for any sudden surge in buying or signs that the consumers are opting for large packs, which could indicate pantry loading. The first 2 waves of COVID-19 infections in India had actually forced some restrictions on the companies selling the non-essentials such as consumers' electronics and smartphones and non-food products. However, such restrictions were only in a few states and in offline retail. Now again, this is extremely overwhelming to read this news that we are all well prepared if the next wave of COVID creeps India. So this is quite relevant to all of us. Now, the next write-up is actually related to the fiscal deficit in April to November at 59% of the full year budget target. The centre's fiscal deficit for the April to November period stood at 9.78 lakh crore rupees, reaching 59% of the full year budget estimate according to the data released by the Controller General of Accounts on Friday. That is on 30th December 2022. The fiscal deficit was actually 45.6% of the budget estimate at the end of October and 46.2% at the end of November in the preceding financial year 2022 fiscal. A sharp 87% rise in the capital expenditure in November from a year earlier, a contraction in non-tax revenue by 11%, and a double tranche of the central tax devolution to the states in the month contributed to the widening fiscal deficit. experts maintained that the center would meet its fiscal deficit target for the financial year 2023 despite higher spendings on subsidies helped by better than budgeted tax collections. As a proportion of GDP, that is the gross domestic product, the fiscal deficit is actually unlikely to exceed in the financial year 2023 to exceed the financial year 2023 BE of 6.4% on a higher nominal GDP. Ms. Aditi Nair, the chief economist, ICRA said, I repeat, as a proportion of GDP, the fiscal deficit in the financial year 2023 is unlikely to exceed the financial year 2023 BE of 6.4% on a higher nominal GDP. Ms. Aditi Nair, chief economist, ICRA said, fiscal deficit is basically the gap between the revenue and expenditure that's funded via borrowings. The net tax revenue for the period was 12.24 lakh crore rupees or 63.3% of the estimate for the financial year 2023, lower than 73.5% at the same time last fiscal. Data released on Friday, that is 30th December, showed. The center's total receipts stood at 14.64 lakh crore rupees or 64% of the current year's estimate. So actually, that's all about the overall analysis related to the fiscal deficit in April to November, which is actually at 59% of full year budget target. Now, dear friends, on this note, I would like to conclude today's session by actually repeating the lines for welcoming the new year 2023 so that we all get charged up to actually tighten the seat belts for another roller coaster that is 2023 and how well prepared we are. The 2022 ride was actually a roller coaster with its own tight turns and steep slopes. Now let's tighten our belt and head with hope into a new year which could actually again be full of surprises. So, dear guys, wish you a very, very happy new year and I really wish the best prospects for all of you for the upcoming year in every possible avenue of your life. And may God's blessings fill your life with lightness, enlightenment, and hope. So, on this note, I would like to conclude today's session. And I really wish you please subscribe to my YouTube channel, that is @KunalNagpal5092, so that you may get notified with the important economic updates and to stay updated with all the economic developments happening across the globe and the Indian economy in particular. Thank you so much. Namaskar. Jai Hind.